Hello, I think it's time to start. Good afternoon. Welcome to the first AASB dialogue series, where we will hear from experts on contemporary accounting and reporting matters. Today, we are pleased to have invited globally renowned researchers, a preparer, and an auditor to share their insights and experience about TCFD implementation. You will also hear from AASB staff on some updates about the sustainability reporting topic. The session today will first start with a presentation by Professor Wai-Fong Chua. There will also be a panel discussion offering their thoughts and experience. We will also have AASB staff, including Nicole and Siobhan, who are leading the AASB's sustainability reporting projects. So please feel free to use the Q&A function to ask any questions during the session. We'll do our best to respond to those questions in the last 15 minutes of the session. And also please note that the session is being recorded. I can see Keith, the chair of AASB, has joined the webinar. I have just upgraded Keith to be on the panel. So perhaps before we begin, I would like to invite the AASB chair, Dr. Keith Kendall, to formally launch the AASB dialogue series. I'm handing this over to you, Keith.
Thanks very much, Eric, and apologies for being a minute or two late with the technological issues. Claim to be good at standard setting. Technology is not my thing. So anyway, it's quite to be able to launch this series. This is one of the initiatives that Eric has put forward and is running with. So as you'll all be aware, this is the first what we hope to be an ongoing series. We have a calendar of events for the remainder of the year. These seminars are planned to be running every 6 to 8 weeks. The next one, for those of you with your diaries open, is scheduled for the 9th of May and will be on intangible assets. At the moment, it's 4 to 5 p.m. That'll be Australian Eastern Standard Time. Today's topic is on the TCFD, and as you may have gathered from the topics for the first 2 sessions, each topic will be, or each seminar will be on a topic that is relevant to the AASB's work agenda, but has a very heavy research aspect to it. And so this is one of the ways in which the AASB is trying to engage much more closely with the research community than perhaps we've done in the past, expanding our calendar of research events, this being the first example, in addition to the research forum that is conducted every November, which most of you would be familiar with already. But this is a particularly exciting initiative in that whilst most of our research events have tended to be very research focused, this seminar series is very explicitly designed to really mesh together research with the needs of the profession and practice. So I really commend Eric for this initiative and being able to put it all together, and it's terrific to be able to launch it. So on that note, I know I'm not the main attraction, so I'll stop talking now and hand back to Eric. Thanks very much, Eric.
Thank you, Keith. So let me first introduce Professor Wai-Fong Chua from the University of Sydney. Wai-Fong, while I introduce you, perhaps you can now share your slides and prepare for the presentation. So Wai-Fong is an internationally recognized researcher who has published widely in many top-ranked journals. She was made a member of the Order of Australia for her research, educational services to universities, and mentoring achievements. In 2019, she was recognized for her significant contribution to the accounting profession and was inducted into the Accounting Hall of Fame. Wai-Fong has had an interest in social and environmental reporting for many years, and she has written several research monographs on the subject. Today, we are delighted to have Wai-Fong share her insights on TCFD. And Wai-Fong, I'm handing the presentation over to you.
Right. Thank you very much, Eric, and thank you for the opportunity to speak to folks about a topic that's very dear to my heart. I hope you can all see the screen. And for those of you who may recognize this bulk coal carrier, it actually landed up on Norway's beach at Newcastle in June 2007. And at the time was recorded as the 8th largest insurance claim, amounting to just under 1.5 billion. And of course, it disrupted the port of Newcastle. It was the biggest disruption in its history. And I think it's probably events like this that make us think about why is it that folks are getting interested in issues to do with climate change. And I'd like to talk about the interest, and at the moment, tried also to ensure that my slides move. Thank you. So you can see that there's growing interest in the financial impacts of climate change. And most important of all is the work of the Task Force on Climate-Related Financial Disclosures. The task force was a creation of the Financial Stability Board under the chairmanship of Michael Bloomberg. And most recently, of course, IFRS has also formed the new International Sustainability Standards Board, and there's various other initiatives. The TCFD is a very interesting framework. The final report came out in 2017, and here are some key characteristics of the report. It's adoptable by all organizations. It can be customized to specific organizational strategies and priorities, can be included in financial filings. And most important of all, it is to try and encourage organizations to think about what climate change poses in terms of both risks, but also opportunities, as not only our economy, but that of the rest of the world moves towards a much more lower carbon footprint. And the emphasis is on trying to provide decision useful and forward-looking information. Now, this is the framework which you can find in the report, and it has 4 key components relating to the governance, the strategy, the risk management, and of course, metrics and targets. And when you look at the framework for disclosure, it is clear that the TCFD was intended as a tool that would enable organizations to review their operations, to consider for themselves in the first instance, what are the risks and opportunities posed? And you'll notice that the metrics and targets come towards the end, because much of the work is actually up the front in terms of getting buy-in from the board of an organization and then working through the strategic components. And the other bit I'd like to emphasize about the framework is not only does it talk about risks, and these are both in terms of transition risks, which is when entire markets or industries move to a lower carbon footprint, not only in terms of physical risks, which is, for example, what happens if you have a port that is going to take in coal and suddenly you have an East Coast low, that actually means that the port is out of action for quite a significant period of time. But on the right-hand side, it is also about the opportunities that climate change offers. And if you've been following the COP discussions in Glasgow recently, you will know that folks like Andrew Forrest are very keen to try and promote hydrogen as an alternative energy source. So there are issues not only in terms of challenges, but also in terms of opportunities. And what the TCFD encourages us to do is to look at the financial consequences, both in terms of our balance sheet items, the assets and liabilities, but also what it means for our income statement and how might operations be affected. Now, from the TCFD, you will find principles for effective disclosure, and these are not surprising. That disclosure should be relevant, should be timely, should be comparable. Now, this is where the sticking point comes, because at one level, it was intended to be something for an organization to use, for it to review its operations. And hence, when it first started, even the TCFD folks were acknowledged that compiling such reports are not going to be easy. For instance, one has to start making assumptions about what the future might look like. What are the climate-related scenarios that one might use to build our analysis of the future? And currently, because there are no publicly standardized scenarios that are used across sectors or even across an industry, then it does become difficult to actually develop comparable data. But of course, then the task force does encourage us to learn by doing, to start and then to begin on a journey. So when we started this research in 2018, we decided to actually interview a large enough sample of folks in various capacities for us to understand what was the demand and also what was the kind of supply that was coming forward. So we had two relatively simple questions. How are preparers measuring climate risk? What are the limitations and challenges, both in terms of risk and opportunities? And how are viewers sort of interpreting these climate disclosures? So we had a look at the ASX 50 to see what kind of climate-related reports were being produced. And we interviewed over a period of a couple of years, some 48 stakeholders, and they come from not just asset managers and owners, of course, that was a very important part of the sample, but also representatives from banking, from insurance, and oil and gas, and a variety of regulators. And we also spoke to some climate scientists. What were some of the findings then? First, the demand was very clearly increasing. And in fact, one interviewee said that it was almost like a tsunami of demands. And of course, then in June 2018, in a speech, John Price, who was then at Essex, said, really, if climate risk is a material risk, then you need to disclose and to measure it, just like any other risk that an organization would face. And of course, in analyzing the reports, we found that publicly listed entities were attempting to assess and disclose climate-related financial risk, some of which could be fairly significant, as in one interviewee who said it looked as though it was going to be around 190 million, but over a period of some 10 years. But not only did we find efforts to try and quantify and to measure this new risk, it was also clear by talking to a variety of folks that the quantity and the quality of the disclosures did not match the urgency of the demand. And there were kind of three key challenges that folks talked to us about. One was at a very conceptual level. How might we come to an understanding of what a scenario is and whether there were standardized scenarios that could be used? Even things like what counts as a stranded asset. If you have a long-term contract for the supply of coal, at what point do you think that needs to be revalued and is effectively stranded? Then, of course, we talked to folks who were attempting to look at how they might incorporate some of the information that climate scientists are producing. The challenge, of course, is that climate models are incredibly complex. They use petabytes of data, and they take months to run changes or variabilities in the modeling, largely because they're modeling, hundreds and very many variables at the same time. And so trying to get that information and say, look, I have an asset sitting in Newcastle at this particular spot. What are the implications of the microclimate for that particular asset is a challenge indeed. And I think then there are commercial and what I would call structural challenges. A climate scenario is not a forecast. They are what I would call forward-looking narratives of what the future might be. They are stories, and so inherently uncertain. And of course, most preparers and accountants like us do not generally like to disclose uncertain forward-looking information, even when it is material in nature. And of course, there are litigation risks that are posed because we live in capital markets with continuous disclosure regimes. We live in the presence of short sellers. If you were to put forward information that was highly uncertain and it looked as though your organization was going to be in trouble, are we inviting, are we spooking the market and actually inviting sellers to come and short the stock? So there were these challenges, and we found investors and regulators actually calling for greater specification or some level of guidance that would enable greater comparability of information. And so we started actually a second related project following what I would call a standardization project, which was to try and develop guidelines for the measurement of physical risk. This is an initiative called the Climate Measurement Standard Initiative. It was a collaboration of Australian industry-led folks from climate science to representatives of banks, insurers, the big four firms, academics. And it was focused on a quite narrow topic, trying to understand the measurement of physical risk in particularly for buildings and infrastructure, trying to generate some comparable information. And you can look at the initiative, but here I just would like to quickly talk to you about some of their key recommendations. One, they suggested modeling using two scenarios, one representing average temperature increases of under 2 degrees centigrade, and the one higher. And so the RCPs, the representative concentrated pathways, suggested was the 2.6 and the 8.5. They also suggested relevant years, perhaps 2030, and then 2050, and probably 2090, because these effects take decades to eventuate. And then suggesting assessing financial impact across portfolio splits, hazard, different types of hazard and the threats they posed. And also if you had assets in very different geographical areas, then one needed to actually model them quite separately. But the interesting I wanted to focus on really was their suggestion that one needed not only to indicate the uncertainty of some of the information via a quantitative range, plus or minus 30% for certain hazards, but also giving a confidence assessment, which was a qualitative assessment of how confident you were in the information. So what we did, we observed both the meetings of the scientific committees, which was really mainly climate scientists, and also meetings of their financial and business communities. We separately interviewed about 15 of both members of the committees. And our preliminary finding relates really to the construction of this thing called uncertainty. Now, most of us in the quantitative sciences see uncertainty as a technical measure. But for us, it seemed that it was actually a cultural phenomenon, and we had two quite distinctive communities. One, you had a scientific community that was very focused on careful detailing of uncertainty. So they would talk about these quantitative ranges, and they would also talk about qualitative assessments of confidence. Whereas on the other hand, we talked to folks in business, and they were traditionally keen to fix uncertainty in the sense of giving point estimates. We have point estimates in our annual reports. We have equity modelers sitting in equity firms that plunk in one number rather than a whole series of numbers with widely varying uncertainty ranges in their models. And so it was very clear that somewhere in the middle, there were quite significant differences, and there had to be ways of thinking about how one bridged the gaps between such different communities. And then in terms of, and so finally, just some quick conclusions around the two projects that we did. One very clearly was the desire for greater specification and guidance. And in this, I want to note, of course, that we do expect an exposure draft soon from the AASB. There is a desire for investors to see forward-looking information, but by definition, that becomes uncertain information. We haven't talked yet about the quality of assurance, and hopefully Adrian will talk about this, but that too was mentioned as an issue that needed to be addressed. We talked about the differences between different knowledge communities and how one bridges that, and of course, the kind of structural issues when we have capital markets that operate in certain ways. But I don't really want us to kind of finish on looking at the challenges without thinking through the what next in a much more positive way. And I want to go back to the very start of the presentation where we talked about not just the risks, but the opportunities. And I always say the ocean can be bluer and cleaner at the same time. Reference, of course, to the old days where we used to talk about blue ocean strategies when we thought about ways in which we might move forward with new opportunities. And also to remember that if you are interested in this, then really it would be helpful to think about governance and engagement right from the very top of an organization down to the operational folks. It will need capacity building and of course investment in time, because we're not dealing with risks that are in the kind of traditional sustainability sense, but they are financial risks that are quite different. One, because of the sort of complexity of climate science and the way in which it will then impact upon how we model the future. As we know, it's very hard to predict extreme and compound events. And time horizons are both long and short. They're long because people say, well, it's going to take some time before these average increases or hazards occur. And yet time is very short because folks will tell you if you don't act now, then the horizon is actually much reduced. I think the other important element is to talk about this as a journey. And so if one doesn't start, one never goes anywhere. And the importance, as the TCFD is always key to remind us that one should start and one learns along the way. And so organizations speak to us about how they begin with a rough sense just by working out both their direct and indirect reliance on fossil fuels, both in terms of operations and supply chains, in terms of the data they may already have available, in terms of their historical vulnerability to specific events, and then being able to do a sort of heuristic in terms of categorizing and prioritizing both the risk and opportunities. Then they speak to us about multi-year work plans, deciding what capacity I have that I can insource, what might I need to outsource, and then of course working out accountabilities as to who is doing what and when, and then moving towards thinking about metrics and targets and executive compensation. So internal conversations to begin with, and then having a sense that your strategies are both adaptive and evolving, and they will include disclosure strategies as much as your kind of strategies around what risks you want to mitigate as well as what opportunities you want to explore. And so I think the future is complicated, but it's very exciting. And I want to thank both the funders who've managed to support our research, the CIMA in the United Kingdom, as well as the University of Sydney. And of course, thanks to the AASB for giving us an opportunity to present our work. And the research is both, it's a joint piece of work with myself and my colleague, Tanya Fiedler. Thank you very much. And I'll stop sharing now.
Thank you, Wai-Fong. Thanks for the brilliant presentations. And I would now like to invite the panel to provide their perspectives. So on the panel, we have Adrian King, who is a partner from KPMG. Adrian leads climate change and sustainability services team in KPMG Australia. He has over 30 years of experience working with public and private companies all around the world, providing financial and non-financial advisory, reporting, and assurance services. Adrian is also currently a member of the AASB and AASB Sustainability Reporting Project Advisory Panel. Then we have Professor Naomi Soderstrom from the University of Melbourne. Naomi is a world-renowned researcher in the field of sustainability and management accounting. She has presented her work at over 60 institutions all around the world, as well as publishing in many top-ranked publications. She's been an editor for a number of global high-ranked prestigious journals in accounting. Ramana James from Insurance Australia Group, IAG, one of the largest general insurance entities in Australia, has a lot of experience with sustainability. He has worked in many companies all over Europe and Asia on sustainability and climate change. Ramana has vast experience in integrating and implementing sustainability that supports a company's strategic priorities and commercial success, including climate change disclosures. Welcome all panel members. So perhaps let's start the conversation with Ramana. Ramana, would you like to share your experience from a preparer's perspective on the TCFD implementation?
Hi, thank you, Eric, and good afternoon to everybody. Hey, I can see why you're a Hall of Famer, Wai-Fong. Just even those next steps, what a great simple guide for people that might be kicking off. I wish we'd had that back in 2017 when we started our journey. I think your research is very valuable and useful for practitioners. But maybe I could start, there's sort of three things that I thought I might share. The first one around getting started and how you mature through time. The second one around remembering the importance of it linking to strategy and risk management, not necessarily letting disclosure drive the work. And the third one, to the point that Wai-Fong made around the care around forecasts versus an uncertain prediction of what, or a narrative of what the future might look like, and how we as a collective navigate our way through that so that we can get improved disclosures that help and inform decision making. So for the first one, we started in 2017 with a TCFD aligned disclosure, which had the sort of four headings: governance, strategy, risk, metrics, and targets. It was probably a page long, maybe a page and a half. It was fairly immature, but at least we'd kicked off. We'd used the TCFD guide to start our journey, as Wai-Fong called out. It has now evolved to a 23-page full climate-related disclosure, and it's built in quite a lot more maturity in that time. Maybe just sharing what some of that has looked like. You know, it's gone from quite qualitative, high-level descriptions of what we thought some of those risks might be, to actually undertaking physical risk assessments and scenarios, doing that for transition, and then even evolving that to start to look at quantitative inclusions and how that might start to play towards financial impacts. As an example, in assessing transitional risk, we're able to disclose that embedded carbon risks across our supply chain were relatively immaterial in the range of 0.03 to 0.05%. So it's starting to look at ranges and starting to look at that uncertain narrative or start to be able to talk to that. And then we've become even more sophisticated in the last disclosure that we made, using the scientific research that we've done through in-house capability to assess the changes in natural perils through time, started to overlay that on the portfolios that we hold and what might be some of the potential impacts at different scenarios at a future time horizon on those portfolios, and an example being claims losses. So there is definitely, that's a 5-year journey for us, and we have matured considerably in that period of time, but we wouldn't have been able to jump to the disclosure we've just done straight away. We needed to take that journey to get to where we are. The second one is the importance of practitioners, like myself and my team, which have an accountability for this within IAG, but the importance of us thinking about this in the context of organisational strategy and risk management. So rather than feeling that what we're doing is driving a disclosure and everything we think about is what's in the disclosure, we need to bring that back and actually go, what is our organisational strategy? What are the decisions we're making? How does climate change and the scenarios within climate change impact on our ability to deliver on that strategy and the decisions that we make? And how have we embedded that into our risk management processes? So we have an enterprise-wide risk profile, and climate is our key risk within that profile. And then we embed and manage that risk across the enterprise, working with many parts of IAG to effectively manage that risk. Now, at the end of that, really importantly, is how we disclose what we're doing. That work that we've done, how is that disclosed for our stakeholders, for them to make informed decisions and choices around our organisation? But again, strategy and risk management should drive this, not the disclosure itself. It's really important as someone applying this in an organisation. And then the third one is this piece around the sensitivities of what we might disclose to the market. And as Wai-Fong really succinctly and well described, that challenge of ensuring that what we're putting out there is not seen as a concrete forecast of what the future is going to be, but understanding that there is inherent and actually quite large uncertainty that sits in the modelling itself, in how that modelling gets applied to portfolios, to assets, to products, and how that might then translate on a 10-year versus a 20 or 30 versus a 50, 60-year horizon. So I think that's something that's going to be really important, that we all, as practitioners, as assurers, as readers and investors of data, how we all understand that and work our way through that to increase the level of comfort that those disclosures are providing a useful suite of data and information that can help inform decisions, but it's not overread as a financial prediction of what the company is going to be in the next 10 years, as an example. So from a practitioner's point of view, the TCFD is a really, really useful guide. Adrian, I think, is going to share that it requires other standards and assurance methodologies that you might need to apply to do a disclosure effectively, but it certainly provides a really great guidance for organisations to get started. And the only other thing I'd just share is where our disclosures have occurred has matured through time as well. So, for example, we started off with, as I said, quite a short disclosure within what's our annual review, which is a document that accompanies our annual report and our statutory disclosures. So we started with an annual review disclosure. We've now got a fairly comprehensive, detailed disclosure in our annual report, alongside our sort of statutory disclosures. We've got components of it within our annual review still, and then we've got a more lengthy and more detailed climate-related disclosure that we make public through our website. And so you've got varying levels of coverage that you'll have with your disclosures through the various disclosure channels that you have as well. And that's, I think, part of the maturity process as well. But hey, I'll stop there, and I'm looking forward to being able to answer questions later on as well. Thanks, Eric.
Thanks, Ramana. That's been very helpful. And before we ask Adrian to share his experience in auditing, let me first ask Naomi to share your insights for research on the ASX 50 report.
Okay, hopefully I'm sharing my screen. This is reporting research results, so unfortunately I need to provide some PowerPoint. So this actually is kind of a nice follow-up to the initial project that Wai-Fong was talking about, because what we've done is we're taking a look at the ASX 100. I'm reporting on the ASX 50 because this is evolving research, but we're looking at detail in what companies are disclosing, and we're looking across a lot of the different disclosures that Ramana was talking about. So one of the things that TCFD discusses is that you should be looking at a variety of scenarios. And so the question is how many? And typically you would have companies early in their disclosure journey doing one or two and then becoming more mature. And so this is just looking across industries to show that there is a variety in the number of scenarios that are being reported by companies. Out of the ASX 50, 36 are currently reporting on scenarios. And the industries that appear to be ahead are banking, energy, insurance, transportation, utility companies. Now, some of the companies are not doing these scenario analyses every year. These are really long and detailed exercises. So what they might do in their financial reports is say, well, we've done these scenario analyses back in 2019, 2018, you should look at them. Now that makes it a lot more difficult for investors to look at. But that's a strategy that companies are doing to be able to increase the number of scenarios that they're looking at. If you look at what kinds of things the scenarios are covering, a lot of them, so the none is the light blue. And then what are the focus really of the majority of companies are kind of I guess it's sort of peach colored and blue. And what we see is that most companies are looking at whole of business impacts, or they'll do multiple scenarios and they'll choose different types of scenarios depending on the different part of their business. So for example, Telstra talks about whole of business transition risks, but then focuses on physical risks related to infrastructure and their supply chain. BHP includes 3 company-wide scenarios and then focuses on the steel sector to take a look at a deep green scenario that they've produced. Now, as was intimated by Wai-Fong's comments, there's a lot of inconsistency in the scenarios, and there was this push to get standardization, and that is not happening, at least currently. So there are many different bases that are being used for scenarios. And so Wai-Fong talked about the RCPs. The SSPs are on top of the RCPs and basically talk about socioeconomic impacts of the different climate change scenarios. IEA has come out with some energy related scenarios, and then we have some scenarios that are based on other types of scenarios. Now, the problem is that the RCPs and the SSPs don't talk about how you get there. And so companies are faced with trying to come up with a story about how we get to whatever the scenario is. And then the problem is that that's not necessarily disclosed. So it's difficult for investors to understand how the company's results or conclusions relate to the scenarios. The time frame for the scenarios are also very inconsistent across companies. And then the nature of the scenarios, and once again, how we get there. So for example, BAU is business as usual. Steady decline means that we keep things under control and our carbon goes down kind of at a steady rate. Tumultuous decline as we go along at high levels, then all of a sudden there's a catastrophe and we decline. Well, those have very different implications for the scenario results that or conclusions that you would come up with. If we look at what's being disclosed specifically in the annual reports and the financial statements, the impacts are typically discussed qualitatively. In fact, we only found one in the ASX 50 in 2021 that took an actual provision. Everyone else is discussing qualitative aspects of the risk. So in terms of asset impairment, consideration of useful lives with their non-current assets, or credit risk related to their customers. And so we don't see a lot of, maybe it's because of the uncertainty and potential consequences, but we don't see a lot of financial impacts directly being hitting the financial statements. So some brief observations. Companies are spending a lot of time reporting on risk without discussion of strategies. And this gets back to Wai-Fong's suggestion about, what's the good news? Well, I think it's important to focus on what companies are doing. And I think to some of my other research on cybersecurity risks, which has some elements in common, what we find is that companies are reporting their cybersecurity risk mitigation. And the capital markets reward companies for doing this. So if companies are demonstrating that they're mitigating the risk, they aren't saying, oh, by the way, we've got this specific cybersecurity risk and that specific cybersecurity risk. They're saying, here are the things we have in place to manage the risks as they come along. And that's something that I think that standard setters should encourage companies to do. We still have a diversity and inconsistency across scenarios. which may be very important from an internal decision-making standpoint, but it's difficult for investors to use the information. And so we have to really balance the value that companies get from doing the internal analysis versus what we want to provide to investors. As Ramana said, this is a journey, and as Wai-Fong said, this is a journey. And we do see, we will be looking more over longitudinally at what these disclosures are. We do see change even in the 2 years that we've been looking at on a preliminary basis. So thank you very much for the opportunity to share this very preliminary and very speedy results of our current study.
No, that's some really interesting findings there, Naomi. So let's move to Adrian. Adrian, would you like to give us some perspectives on your audit experience on this subject?
Yes, certainly, and thank you for the invite and the opportunity to present today. So I lead our climate change and sustainability practice at KPMG, and I've had the privilege of leading our global practice for many years as well. Most of our work focuses on either developing a climate strategy, preparing TCFD type reports, disclosing those strategies, and then assuring those reports. It does need to largely happen in that order, because you can't disclose a strategy until you've developed it, and then you can't assure something until you actually have a report. So it does typically follow that order. But today I'm going to focus on the last part, which is the assurance part of it. So there's a number of areas and challenges that I just want to talk about briefly today, and then happy to take any questions. The first is the type of people preparing these reports are different to would prepare the rest of the annual report. And as a result, the audit teams that I have auditing this work is very different as well. In a classical financial statement audit, it's probably 80% of auditors and then 20% of specialists, whether they're IT or treasury type specialists. In this type of work, it is quite content heavy, and so it's almost the inverse of that type of skill set that's needed. The second challenge is about the assurance scope. So there is no mandatory assurance at the moment, so it is decided by the company. Now, why would a company deal with this or have assurance? It really is to give some credibility to the, as Naomi said, the stories that are being told. There is a lot of greenwash out there, not intentionally, but largely through naivety and also because of the maturity of an organization's disclosures. So really, again, the assurance obviously focuses on ensuring that what is disclosed is accurate and complete, as all assurance does. Most assurance in this space is typically limited assurance, unlike the annual audits of reasonable assurance. And that does also add some real challenges in this area, because in a financial audit, the half year might be limited assurance, the year end would be reasonable assurance. In this case, the information is typically not bookended by that reasonable assurance. So what is sufficient levels of work to achieve limited assurance? It can be a challenge. The third challenge then is actually, well, what is going to be assured? The TCFD report, you see the 4 pillars and the 11 requirements, but that information covers some nice straightforward metrics and targets and footprints. It can also cover a lot of the actions and achievements that the company has made in a given year. It can talk about offset strategies and assumptions of carbon prices. It can talk about the physical risks around climate change, but also the transitional risks. And then organizations choose different frameworks. There are a large number of frameworks depending on what the topics are, what the geography is as well at the moment. So there is a number of different frameworks that need to be navigated around. And it really is one of the challenges, especially as part of the assurance, is making sure that the organization is following the frameworks, because whilst TCFD, it's been around since 2017. Say some companies like AGL and BHP were reporting back in 2015, so it's been around a while. It's a pretty good start and pretty good standard, to be honest, and it's going to continue to get evolved with things like the AASB. But it already does have 800 odd pages of standard guidelines and examples. So it's pretty rigorous or pretty fulsome, shall we say. Yes, there's a bit more to be done in terms of turning it into a pure standard, and so there's a lot of additional disclosures that are often required, but certainly it is a really good place. And then again, really, the challenge on assurance is really, well, which frameworks have been chosen and has the organisation actually followed them? Are they telling the part of the story or the whole story? And actually, is that information accurate? There's a lot of this information that's never been disclosed, never been presented, never been audited in the past. And so the audit process can really give management, but also the board and obviously the external stakeholders, confidence that this information actually is reflective of what is happening within the organisation and is not just a set of nice to have announcements to get them through a certain AGM. So with that, I'll pause and pass back to you, Eric.
Thanks, Adrian. So I think the panel discussion has been very interesting because you touched on many different perspectives. You talked about challenges from the preparer's perspective on TCFD, but also talked about the opportunities on using TCFD as a starting point. And then we also heard from Naomi about the behavior and the disclosures and how they select what's important for the entities by using TCFD framework by analyzing top entities in Australia. And we also heard some challenges in auditing as well from Adrian, which also included assurance challenges and opportunities. So we have about 10 minutes for the audience to pose questions for the panel and presenter to answer. There's a Q&A function for you to ask questions if you would like. There is a question being received though. The question is, should entities make an annual provision for future climate change costs? And then there's also a question about tax deductible. But let's start with the first part of the question. Should entities make an annual provision for future climate change costs? It's a question for the panel to answer. Ramana, I can see you have unmuted yourself. I assume that you want to answer that question.
I'm Eric, happy to jump in, I guess. I love the idea of tax deductibility. That sounds like a really great idea. I think the challenge is going to be around the uncertainty of it. So making a provision for something that you really aren't quite sure how big or little that might be, and even how far apart the ranges of that might be, could be quite challenging. And I think if I was an investor of an organisation as well, that would make me ask lots of questions around the appropriateness of that provision. But do we need to get to the place where we are able to better quantify that future impact? And does there need to be potentially different ways of treating that from a financial point of view, but also from a taxing point of view? I think, yes, that we're going to have to be innovative and creative, and the economic system is going to need to evolve to deal with what is going to have an entire economic system impact. I think there needs to be new ways of thinking when it comes to this type of thing.
Thanks, Ramana. Any other panel members would like to comment on that question as well? I think, yeah.
I was just interested that even Ramana, right, working for IAG, an insurance company probably has the best database I've seen on hazards, right? And it's an information that most organizations don't have, because most don't track the way that the hazards are occurring and so on. So even you with your database is to say, I'm not sure that we're at a position to actually make such a provision. Of course, tax deductible, I think the governments would run a mile before they allow that, right? Because if it's so uncertain, how would they actually then be able to allow you to claim a tax deduction? So anyway, I just was interested. So I think, I agree with you that we need to get there, but I think we probably a little while off yet.
Thanks, Wai-Fong. Okay, so let's move on to the next question. I've got another question came in. It is, what does the panel think about the AASB and the prototype standards, and how will they impact what entities are currently doing? Perhaps before I go to that question to the panel, can I invite Siobhan to come on the camera? And so Siobhan is leading the sustainability reporting project at AASB. Siobhan, would you like to give an update on where it's heading and what the AASB is doing at the moment, please?
Yep. Thank you, Eric. So The AASB is very active in this space at the moment. At its February board meeting, we did start to discuss some preliminary considerations for drafting a project plan. And those really key, I guess, tentative decisions that the board made to help us with our project development is that we will seek to develop a separate suite of standards that will operate alongside the AASB standards, and that in doing so, we would look to the work of the International Sustainability Standards Board with modification for Australian matters and requirements. But the board really emphasised at that time that the focus of the project should be to prioritise international alignment and only amend international sustainability reporting requirements where it's necessary to do so. And we also decided to focus initially just on the for-profit sector and do further outreach and research with the not-for-profit sectors, just to figure out the relevance of sustainability reporting and the, I guess, the importance of information for them, because they obviously have a very different focus to for-profit entities. So we're really excited about this space. We are expecting 2 exposure drafts to come out of the ISSB within the coming week or 2. And these should be based or very closely aligned to the prototype standards. We are also planning on doing extensive outreach on these exposure drafts. And we will be going back to the board in April to discuss those outreach plans and also to further consider and clarify exactly what the scope of the project will be. So yes, with that, I'll hand back to Eric. Thank you.
Thanks, Siobhan. Adrian, do you have any comments about the ISSB protocol?
So just so I can see a few questions coming through on this related topic. So certainly, first of all, it's we think it's a great initiative to standardise and consolidate some of these standards. Really expecting that we've seen the prototypes at around Christmas. Obviously, we'll see what comes out in the exposure draft, but certainly expected it to be a consolidation of a number of different frameworks, being the TCFD framework we're talking about today, but it's also CDSB, another one, IR, another one, AASB, another one. So again, it's good that they'll be putting them together, but also taking them to a more rigorous framework that is then implementable and, of course, auditable. So certainly very supportive of that. Certainly very supportive. I see a question that about it coming into Australia and what's the position on the AASB's position. Again, certainly supportive of the initial voluntary position with a move towards mandatory as soon as the standards and the frameworks permit that to be done, and of course other regulatory components as well. And yeah, I'll probably pause there because I'm sure others will have a comment on ISSB.
Thanks, Adrian. Any other panel members would like to comment on the question? Okay. Okay, I don't, yeah, sorry, Wai-Fong, you go.
Oh, I was just going to comment on the, what is the panel's view on the proposal to endorse voluntary adoption of TCFD? I think a bit like Adrian, you know, it was quite interesting for us to see the speed at which, you know, the United Kingdom has started to think about legislating that in New Zealand and of course now the US. So, and probably it's because, as Adrian has said, that really there is, you know, 800 pages. There's a lot of work that's gone into actually trying to make this into a more robust framework. And I can understand why folks would want to go for voluntary adoption, right? Because if it is a journey, you can't really expect organizations to kind of on day one get it right. And this is kind of the answer to the last question. Can you comply and still recognize you're on the journey? Well, I think most of the standards are kind of principles based, right? No one is going to tell you, you must use this and now you must do this. And I think folks realize that it is about capacity building within an organization. It's going to take investments, not just in people, but a time to actually mature your systems to collect data and to actually learn how to interpret what are the trends might be in a very complex area. So I think really there was no other means except at the beginning to think about voluntary adoption. I just think it would be too difficult. The politics would be too hard to get, let's say, mandate this from start. It just, I can't see it happening. Anyway, that's my 2 bits worth.
Thanks.
So I think it's really interesting because there's such an urgency to get this done, and that's not the way we typically do our accounting standards. And so having it be a different process, I think, is really important. And if you look at all of these different standards and guidelines that are being consolidated there, if you complied with all of them, there would be, I don't know, 40,000 different items that companies would be disclosing. So I think we need to get in there, and I think the voluntary road is the way to start as we get more understanding of what is meaningful. And I think this is where research is really important, you know, to give myself some future work and Wai-Fong some future work. I think it's really important that we understand the value of things. We have these guidelines, some of them have come out of the ether somewhere, and some organization is saying this is what's important and this is not. We really need to understand that, and we need to have companies starting to do the disclosures as we learn more about what are going to be meaningful disclosures that will help companies along the path and help investors and other external stakeholders gain value from the disclosures, and then also how to assure them.
I was just going to say, I certainly do think it's it is possible. You can only disclose what you're actually doing. So most of the uncertainty is actually in what the organization's climate strategy is, rather than the actual disclosures. So, I mean, already in the UK for this year, it's a mandatory requirement for premium listed companies, and I think it's even moving down to the next level. So it is possible to do that, and we are doing that already. So the issue and the variability, I don't think is actually in the standard as much as actually is in, well, what is the level of the organization's understanding of the risks and the opportunities, and what are they going to do about it? And the more mature organizations can get quite a long way. So, for example, 4 weeks ago, I signed off on the Rio Tinto climate report, and I actually signed off that their Scope 1 and 2 targets were aligned with 1.5. So that's a pretty advanced stage to get assurance on that, not just to say it. So, it's not many people would be ready to do that because they wouldn't have the company plans and the capital allocated to actually be able to say and claim and demonstrate that.
Look, I'm conscious of time. It's been a wonderful discussion, and on behalf of the AASB, I'd like to thank today's keynote speaker, Professor Wai-Fong Chua, panel discussants, Professor Naomi Soderstrom, Ramana James, and Adrian King. Thank you for sharing your insightful thoughts and experience. I think most people would agree that your sharing has been highly beneficial to us in considering the challenges and opportunities of the TCFD and how we move forward as a whole community. So the next AASB Dialogue Series will be held on the 9th of May, as Keith mentioned at the start of the session. We will be exploring some key issues on tangible assets, including whether the accounting standards should be improved to make intangible assets information more relevant to users. So thank you everyone for attending this webinar. We hope you found this useful, and see you next time. Thank you all.
Thank you, everybody.
Thank you. Bye-bye.